Perhaps I just want to reiterate, remember the SAM, if you shock it, whether it's a positive or negative shock, the percentage change will stay the same. Because the multiplier stays the same. It's just how you interpret the change that you're looking at. Okay. It won't make a difference to the percentage change. Okay, so this is really very easy. I think once you understand how it was put together and how to use it, you'll see it's very easy. It's just a technique and it's just identity. Remember I told you, if you look at your revenue, you will see is that it is based on, the change in your revenue would be based on what is your tax to GDP ratio, what is the growth in your real economy and inflation, and that should give you your revenue. The only thing that this is helping you is just at a glance, you can build scenarios and you can shock it, and it will also give you what will be the revenue outcome. So it's also what I think you can call like an impact framework or technique or model. And then you see I've also got 2 scenarios included here, so you can also shock the model and then see what will happen with revenue. I think the other thing is that you can build it every year. It's very easy to populate, it's very easy to update, and it's also very easy if you've got enough information to shock it and then in a fairly quick turnaround give an answer. Because we all know that you that are working in research and analysis departments or units, you sometimes get very short notice to give an answer. You don't have time to actually go and explore how you can do it and what you can do. They need an answer almost immediately. So there's also, I always say, rather be roughly correct or in a plausible number than missing the train. So if you want to try and see now, but I want to be so precise and I want to do this and this and this and this, then the train is passed. So you also have, so this I think is also a way that you can actually sit in a meeting and answer questions as it's asked. So you will start off with budget assumptions. In this case, it's budget assumptions for 2025. You will need your previous year actual GDP, or you must remember it's an estimate, so it can still be preliminary and a preliminary estimate or an actual estimate. So you've got your nominal GDP, and then you need a forecast for your current year that you're now working on. And you can also build a model for the following year. So it all depends on what question you need to answer. And so in this case, we're working with the current year that is, current in year. So we've got a forecast for 25, 26. So these values is actually values that you will populate your assumptions. And when you are going to use this model and you are going to do a report and you are going to give outputs, you always have to state your assumptions up front, because you can do a scenario where you change these assumptions. So we know what was the actual growth in 24-25 in nominal terms, and we know the GDP deflator and the real growth. And you will see if you add up these two, it actually gives you the 5.2%. So what I also want to tell you is I've just done this one with a deduction, but let me see if I've done this one correctly. So we all know if you want to add, you can add the inflation and growth and get a proxy for the nominal growth. But if you want to be more precise, you will do it this way. That's the formula. So what you will do is you will say 1 plus the growth in the economy times multiplication 1 plus the inflation rate. So that is a more accurate way of if you want to go from real to nominal. But you can also, as a proxy, just add or deduct. So you will see is that in the GDP growth nominal terms, 6.9%, and then you also need to have your target for 25, 26 because you need a tax to GDP ratio. So this is your target that was given. You know what is your GDP growth. There it is. You know what is your deflator or inflation. Usually with GDP, we don't work with CPI inflation. We work with GDP deflator. And then you can actually then calculate your tax to GDP ratio. So that will just be your target divided by your GDP. And then you're going to build your scenarios. So you need to create this little table where you've got inflation at the top, because you want to calculate for different scenarios what will be the GDP nominal increase for different inflation rates and for various GDP growth rates. Now, what I usually say to everybody is you have to anchor your model or your framework. So you have to say what is your current growth, nominal growth, and you can see here is 1.069, so it's that 6.9% that we saw here. And then you build your scenarios around your assumptions. So you set your inflation is going to be 3.4% and your growth is going to be 3.4%, and you anchor your scenarios at 1.069, and all these other nominal increases in GDP is actually scenarios. Okay. So now, usually what you do is that you might want to see at a particular inflation rate or a particular growth rate, what will be the revenue. So you make sure if you want a particular inflation rate or a particular growth rate, that you build it in your scenario table. And you start with the lowest to the highest. So it's just that when you look at your scenarios, it makes sense to you to interpret. And then just remember in this framework that you can only change what is in red. So you can only change this table. If you want to change the growth rates or you want to change the inflation rates, please just do it in this table, because you will see all the tables that follow is actually linked to this table. So I can show you here. So it will be linked to that table. It's just that if you can take out human intervention, do that, because we do make mistakes, especially if we're in a hurry. So I think if you can just see what is the reason why you want the nominal percentage increase in GDP at different inflation rates and different growth rates. Then if you want to, you can also going to see but what will be the nominal GDP? And then here you could see is that it's 44,439 in millions, so, or billions. So then you'll see, what is the, so again, you anchor it in the middle of your table so that you can build scenarios around it. Don't worry about that red one, I'll talk to it now. So now what you'll see is that you can also see what will be the GDP in nominal terms for all your scenarios, for all your increases that you've created, yeah? And then this table is just for your information. It actually doesn't, it's just like just to check it, you will see that you've got a 0, because there's no difference in your budget assumptions and in this framework that you've created. So you are at 0. So these are just telling you what GDP difference is to the budget assumption, whether it will be less or whether it will be more. So if it's got a negative, it's actually a decrease in your GDP. And if it's a plus, it's an increase. And then you can see it at different combinations of growth and inflation rates. So you'll see in this case, at the same growth of 3.4%, and you've got a 4% growth, a 4% inflation rate, your GDP will be 254 million higher. Then you start with your tax revenue scenarios. Again, you can change your tax to GDP ratio, at the moment it's linked to your ratio that you've calculated here, 25.2. It's always good to start with your current assumption for your tax to GDP ratio. Then you can anchor your revenue once again. And again, it will show you for a given inflation rate and for a given growth rate, what will be your tax revenue outcomes. So now you can see is at a glance, you can see what the scenarios are telling you in terms of different combinations of inflation rates and growth rates. And so if you read in the newspaper or the IMF comes and gives new growth rates and new inflation rates, or the Reserve Bank revises its macro model, or the Treasury gives new, your Ministry of Finance give you new growth rates or inflation rates, you can at a glance see what will be the outcome of revenue based on the assumptions of this framework. And then sometimes you just want to see if I change my tax to GDP ratio. Remember yesterday you did your tax effort. So if you up your game and you're actually going to increase your tax effort or you're going to decrease, in this case I've done a decrease, but there's nothing preventing you to say, well, there I see 25.2, but my tax effort shows it should actually be 26. What will happen with my revenue? So now you can see your anchor revenue is already increased. And now you can see is as well, if I can increase my tax to GDP ratio from 25.2 to 26%, this will be my new revenue target, 11,554 instead of 11,203. So that gives me about 250 million more revenue. So if you do a holistic report, this can also then help you to, if you are going to say what you need to do to increase your revenue mobilization, or you've got reasons to say this is where the revenue is going to come from, you could actually then work on the statistics. Now, usually these statistics are used in your budget frameworks. So usually your fiscal framework is based on a GDP ratio. All your fiscal, your revenue, your expenditure, your deficit is all as a percentage of GDP. So this is just filling in the gaps of your revenue envelope within your budget documentation. And so most of the questions or asking about scenarios will actually emanate when they talk about budget outcomes and what should be the revenue for budget if they're going to revise the inflation rate and the growth rates, and then also if you're going to see whether there's a chance to actually increase the tax to GDP ratio, but it might also be that you might see a decrease in the tax to GDP ratio because you've also picked up there are higher non-compliance, or you had tax revenue policies that was actually given a lower tax to GDP ratio. And then once again, you can see if you uphold your assumptions of a 3.4% inflation rate and a 3.4% growth rate, your revenue will actually be 10,443. So you remember your original one was 11,203. So now we 1.2 billion less than what we thought we're going to have in the budget. And so, for instance, you can actually build many more of these tables. It's just that what are your needs and what you want to look at and how you want to look at it. And then here on the right, all I did is I've just put, that was what you saw on the slides. I've just shown for a given tax to GDP ratio and for a given growth rate. There's 3 elements to the framework. 2 needs to be known or kept constant, and then you can work with scenarios with the 3rd one. So in this case is that now you can see if we work with different growth rates, so we're keeping the inflation rate the same. We're not changing that. You will see what is the different scenarios at different tax to GDP ratios, and also at different different growth rates. And then all we did here is we just show what happens if you are going to simulate tax revenue. Remember, I showed you on the slides at different tax to GDP ratios, and I've also shown you at different GDP growth rates what will be the outcome. I'll explain to you what we see here now if we're going to shock the framework or the model. And then this one, if we look at different inflation rates, so we're now keeping the tax to GDP ratio constant and the GDP growth rate constant. So it's really useful in terms of if you want a quick answer to a question, or you read that the budget authority or the fiscal authority has actually reduced or changed the inflation rate or the growth rate. You find it a lot of time when you in a downward phase business cycle that there's adjustments made to the growth rate, not so much often to the inflation rate, unless inflation is posing a big problem. And you could also now say as well, if our governor in South Africa is saying, I don't want the inflation target to be 3 to 6%, and we know then the outcome is like 4.5 or 5% inflation. What will happen if we have a lower inflation rate of 2% in the economy and we don't up our game in the growth rate? We're not getting more growth. Then you can actually use this model to answer it very quickly. So I see everybody's nodding their heads, and so that's a good sign that I'm making sense in what I'm telling you. Okay, so are there any questions so far? Because this is just the basics put together. So you should be able to fairly do it. Yeah?
Yes, so I see that for the tax revenue, it is all the tax kind are aggregated.
You see the tax revenue?
No, for the tax revenue.
Yeah.
Meaning it is the combined impact of all the tax kind.
All the tax, yeah, it's your total tax revenue.
Can I also do a case where I look for different tax steps and look at the percentage?
Very good question.
To the GDP, and then plug that in and see how the tax kind will behave regarding the same assumptions.
Thank you so much. That's a very good question. Thank you for asking questions because it helps all of us. So I just want to repeat if you didn't hear it. We do have a mic here, but we're not using it. But so what he's asking us is that this is total tax revenue, but if we want to do for specific tax types, help me if I'm not repeating correctly, if we want to do for different tax types, are we able to use this? He's now mentioned perhaps also in terms of GDP. Yes, for sure. And it will be very good if you can do it. And you can also use, say for instance, you want to do PIT, you can use the remuneration base. If you don't want, because GDP is very wide. Yeah. So perhaps you want to use gross remuneration, or for corporates you want to use gross operating surplus, or for VAT you want to use consumption data. But if you don't have it, you can use GDP. So yeah, for sure you can do that. There's nothing, and it will also, because you must remember this is a condition that will hold. It's like an identity, that the tax to GDP ratio, the growth in the economy, and for a given tax to GDP ratio will give you the revenue. Okay, so it's an identity and it must hold. And if you want to build more scenarios, that's a very good idea. So hopefully we'll see something on Friday. And it's easy to do. So it's like, yes.
Yeah, I'm thinking about the perception and non-statistical input that affects some of these things. Because the perception, the way the people behave, how would that one be, its effect on some of these things in terms of revenue that we'll be expecting, maybe more or less the social impact on some of these?
Oh, you mean the social impact?
Yes.
Yeah, unfortunately, this model doesn't contain the social impact. So, can I repeat the question and then tell me whether I've heard everything that you're saying? So, this gentleman is saying is that if we take, for instance, consumption and we do the scenarios for consumption, shall we can see what is the social impact? Is that what you asked me?
How will the social impact affect maybe the tax
On the different income groups. Yeah, so you see, this is typically of a boss. Once you do a model and you give them an answer, they ask you the next question. So I can see as a manager. You remember I think somebody working in his section said, this is my boss. So this is typically of a boss. So what I want to say to you is that you must remember a model is put up for a certain purpose. And you can only get an answer out of a model if the data is in that model. You are not able to make conclusions or derive conclusions if the data is not in the model. So this model doesn't have a distribution analysis. Your SAM does. The model that we discussed this morning, the impact model, if you shock activities or commodities, it will tell you what happens to consumption and how does it get to each decile. So you will have to ask your subordinate to actually use that model to tell you if we're going to shock the economy, what's going to happen to the social distribution in terms of income or in terms of consumption. But unfortunately, that data is not in this model. But what I can tell you is once you receive the outcome of this model, what you can ask next is that, listen, apply this outcome to my other model that shows the distributional impact and tell me what is the distributional impact. So once you've got plenty of techniques and frameworks and models, you can link the outcome of one model as an input to another model. You will see in October when we meet, you're going to use the SAM impact model and you're going to shock your microsimulation models, because microsimulation is based on taxpayer return data. So it's got an economic base, economic activity, and it's also got a distributional base, and it's got a policy rates. So you're going to shock either your policy rates or you're going to shock your economic activity, your macro, they call it the macro assumptions of your model for how you model your tax returns for, say, PIT or CIT going forward. And then you are able to actually use this as a scenario for your microsimulation models to see if exports come down, what does it do to gross operating surplus, shock your tax microsimulation models on corporate income tax, and then see how does it affect the different sectors and how does it affect your revenue. So you can link your techniques and frameworks and models so that you have a complete insight into your economy, into your tax policy, and in terms of outcome of your revenue. Very good question. Okay. Any more questions? So I think it's very comforting for me to know when you do see the techniques and frameworks that you think further, that you think, but what can I do with it? What are my needs? And how can I actually up my game so that I am relevant? I once spoke to somebody and I said, isn't it wonderful if you have all these techniques and frameworks? Now you can do insightful reports. And then he said, yes, but my management is not interested. I said, well, just keep on submitting. Just keep up and give it to management. Eventually they will see, but this is how I can use it. You must remember, sometimes we that are technical and we that are in the space and we've got the opportunity to do more, and you don't need to do just what you need to do. Usually management, and especially top management, they're always in meetings. They can't sit down like you. They don't have that luxury to sit down and work on models and technical analysis. And if you can supply them with that, and it's in the space that they can use it immediately, and it's really what they need, I can assure you management will be on your case constantly, because there's always questions when they have their discussions or their management meetings. There are always discussions and they don't always have the answer. So if you can fill that need, just keep on pushing, because what we call it is you're upskilling. You're also informing your management and your commissioner and your ministry on what is possible and what do you have and how you can fulfill their decision making, and sometimes strategic decision making. Do you want to ask a question? Okay. Does that make sense? Yes. What you're asking? You mean the scenario? Yeah, we still have to do that. We haven't done it yet. You see, I must be like a fast bullet train, right? But that's very good. So it just shows that you are interesting, but what was done there. I just wanted to say, are there any questions on the framework? It will be easy for you to use, and you can see how you can use it. You must remember, I told you don't need to remember everything, anything. If you get to your own desk and your own office, I just want you to understand it. Once you understand it, you will be able to do it. You've got the templates, you've got the formulas, you've got the techniques. If you go away here and you understand it and how to use it and how to interpret it, you will be able to do it. Okay. So what, you remember we did the, yes? Yeah, so you can do it on, like the gentleman said, can I do it on GDP? Yes, you can do it on GDP, but it will be more accurate if you can do it on remuneration, because 90% of your PIT is coming from pay as you earn, and pay as you earn base is not GDP, it's remuneration.
Yeah, I was thinking of CIT.
Oh, CIT, you will use gross operating surplus.
And then
On?
where you have GDP deflator,
So you're asking me on the GDP input, but then you won't be using GDP. You will be using, so this GDP will either then be remuneration, or it will be gross operating surplus, or it will be consumption.
so it will be gross operating surplus for 2024-25, and then you would
25, 26. What is your forecast?
forecast 25-26, and then where you have GDP deflator, what would you have, assuming you have still gross operating surplus?
Okay, so that's a very good question. So let me just repeat it. What she's asking us is that, okay, so we've got now GDP, we all know about the deflator, we all know about the growth, and we've got the nominal, but what happens if we're going to replace the GDP with either remuneration or we're going to replace it with gross operating surplus? What will we use as a GDP deflator? Because now the GDP deflator is economy-wide, but now we've limited to two aspects of GDP. So I would say is for remuneration, I will use wage inflation. Okay, because PIT is so much driven by pay as you earn, and usually wage inflation will cover that inflation. And then you must remember wage inflation. If you've got the wage inflation there, then you've got the real growth, and usually the real growth is the employment figures, the growth in employment figures, and then you'll have a total increase, a nominal increase in remuneration. So the difference between the wage inflation and the increase in wages will be the real increase. So you will just deduct it like I think I've done it here. Let me just see. I've got this. I've got this. This one I've just calculated by taking that nominal divided by that nominal. This one, can you see it? It's just a deduction that I made. I take the nominal increase in wages, less the real growth, because I have that. But if you have the inflation, you will just deduct the wage inflation, and then you will apply the deduction here. So if you've got two of these values, you can calculate the third value. Okay. Now remember, I told you this is a crude way of doing it. The best way of doing it is this way, where you do the multiplication. Because this is just a proxy. Okay. But usually when I do this one, I just use the proxy. But if you want to, you must actually multiply this with this to get that. Okay. So if you're a person that wants to be very accurate, please do it. Okay. And if you've got one value and you need a real growth, it will be that one, less that one will be that one. Okay. But you need two values. So that's for remuneration and wage inflation. Now she's also asked, what do we do if it's like GOS? What do we use for GOS? I would say is that unless you've got lots of deflators in your economy, because you must remember you also get sector deflators. So you can get a deflator for the agriculture sector, and you can get a deflator for the manufacturing sector, and the building sector's got a different deflator. Food has got a different deflator or inflation. So we think that you must remember, if we look at the GDP deflator, it's an indication of the general rise in prices over a period. So it's a combination of all the activities. But when you go to a specific sector or specific activity, like medical inflation, have you seen how much your medical aid contributions that you have to make increases much more than the CPI inflation? Because medical contributions is driving the CPI inflation, but it's got its own inflation rate. So I would say, I'm just thinking on what you can use for GOS. I don't think it will be so wrong to use a GDP deflator for GOS, because it's an activity base that's going to happen in the corporate sector. And the corporate sector is actually very much part of the value added. In South Africa, do you know what is the ratio between remuneration and gross operating surplus into your GDP at factor cost? Do you know? Do you know how much is your remuneration? Or let me ask any other country. Do you know how much is your remuneration as a percentage of your GDP at factor cost? It will be quite nice to know that. Won't you want to know it? In South Africa, it's close to 50%. Sometimes it's 51% for one and 49% for the other, but it's very close to 50%. I don't know for the regions though. Some of our colleagues here are doing regional analysis, but it will be quite nice to know how much are your region in terms of the national average. And does anyone else of you know, do you have your national accounts data? I saw national accounts data when I was walking through with the computers. Tell me, what is your ratio of remuneration to gross operating surplus to your total GDP at factor cost? Okay, and then if you are going to use consumption, you want to look at VAT, then I think you'll use the CPI. Okay. So I think I wouldn't say there's only one answer or one way of doing things. I think what you always have to try and do is to be as accurate or refine it to a level that you feel it is the most appropriate. Because you must remember, if you're going to use the outcome of your models and techniques, you want it to be actually refined as best as possible. So if you only got the GDP, you can use the GDP, but just remember your error factor will be much higher, so the conclusions that you can make might not be so precise what it could be if you use a better base. Okay, so that's also a very good question. Are there any other questions that you can think of? Okay, so to come then to using this model as an impact model, say for instance you don't have a SAM and you're still busy constructing it and you're still trying to put the data together, you can also use this as an impact model. But then I just want to allay the fears of our boss that you have to do it on the site because the information is not in here. So if your boss asks you, listen, in this case in scenario 1, where I think tariff impact on exports is on everybody's mind, and what is the direct impact? You must always remember when you talk about impact, you get a direct impact, you get a direct plus indirect impact, then you get a short-term impact and you get a long-term impact. Can I tell you how big the difference can be? When we started with our electricity load shedding in South Africa the first time in 2008, January 2008, it was a huge shock on the economy. Why? Nobody was geared for other electricity besides those that's coming from Eskom, our national distributor of electricity. So what happened? Many activities nosedived because they couldn't produce. They couldn't open shops. I know Mainland. Who of you have been to Mainland? Do you know how big that shopping centre is? You need like a little car to go from one shop to the next. It's so big. It had to shut its doors because they couldn't let people come into the shop because it was too dark. So the risk of theft was very high. So can you think a shopping centre like Mainland closing down because there's no electricity? And we had huge electricity shocks to the economy. A mining sector was severely hit. So all the sectors that were very electricity intensive had a very huge shock. And then unfortunately we also had electricity problems coming in the latter half after the financial crisis, and we had to start hastily buying generators, putting up generators at hotels, at businesses. Those that couldn't afford went onto a manual system. So yes, the disruptions were there, but some companies and some mining companies and some industries were actually able to safeguard a little more to make sure that the impact is not so heavy as it was unexpectedly in 2008, because they didn't warn us that they're going to cut and do load shedding. I think another thing that happened is that there were hours also shut down. So mining companies could only work at night and not during the day. So yeah, so there were lots of shifts. So at that time, if you did we did it at SARS. We worked out what is the loss in production in the economy, what is the loss in revenue, given that we're not producing the electricity, the demand, we're not fulfilling the demand. So we can go and work out what is the impact, but you must remember this is the direct impact now, and there's a longer term impact. The longer term impact would be uncertainty, people not investing, people moving to Botswana, to Namibia, Angola. They go and find other places that's more stable for their industry if they are able to do it. But what has happened since COVID? We see that renewable energy is becoming much more important in our country. I see now Eskom is saying is that, listen, the demand for electricity has weakened so much that we can't make a profit anymore because people are just moving away from Eskom supply because they were told not to use Eskom supply because they cut the electricity. So now that impact has softened because now people use alternative sources of energy. So you must remember those are the structural changes that's happening in your economy. Okay, this is just explaining impact. So just understand when you talk about impact, remember the SAM. When the SAM calculates the impact, it's the total economy-wide impact. It's not only the direct impact, and it's also all the impacts that might happen over 3 or 4 years. So just be mindful if you tell, well, this shows me that this impact is going to be X billion, and this is the impact on revenue. It might not be the revenue for that year. It might be revenue for 3 or 4 years. Okay. So just be mindful, you must state what have you calculated. You've calculated the total impact on the economy, the total impact on tax revenue, direct and indirect, and over time. So you just give one figure. So if you want to say is, but I want to know how much will be on this year's revenue, then you will need to add analysis to see how demand will change over time if you shock it now. So then you need like a regression model to be able to explain that. Okay, so the direct impact, so that is the immediate total direct impact. If you're going to, so there can't be any adjustments to the economy, like I've now explained to you on the electricity sector. So now we say so how do I calculate it? I say textile exports is 50% of imports. So that's my assumption. Where did I get it? I went to fetch the information. I went to read the information. There are studies available. There are stats available on your exports. You've also got it in your SAM. How much of your exports are coming from textile exports? So you should have it when you look at your commodities. So you can use your SAM and say, well, 50% of my total exports and imports, because you remember you also import for this industry, is 50%. Oh, I say textile exports and 50% of imports, because the textile industry also imports. So now I want to see is what's going to be the impact on the economy. So you have to do a side calculation so that you could actually realistically shock your GDP. And then for the direct impact, you will see is I've now taken 10%. When I did my reading and I went to look at my figures, I could see is that if exports are, and I made the assumption that 100% of exports to the USA will not be there anymore, because we just had it on from a tariff impact on exports to the USA. It's 10% of GDP. I have to go and calculate it. It's not in the model. It's not in here. So you need to have it either from your SAM model or from basic calculations that you do on all the information you've got available. Just state what are you using and why are you using it. And then you've got the direct impact. So I've taken 10%. And then I think what I've done here, let me just see. I also now have just to refresh my memory, sorry. I think it's half, 50%. Because I said 50% of imports. And then assume 100% of exports to USA, and it's exports less imports. Yeah, so what you must remember is that if I'm going to shock the GDP is plus exports, less imports. So I have an impact on exports and I have an impact on imports. So now I've stated my assumptions there, and I do my calculations on GDP. And then I see is that the impact on the GDP is only 1,633. And then I can see what is now my nominal growth by taking my new GDP calculation against to see what is the change on the previous year. And I can see now my nominal growth is 3%. Can you see in our assumptions, we had nominal growth at 6.9%. Now I'm saying is nominal growth is going to be 3%. If nominal growth is going to be 3%, how much is going to be real growth? We know what is inflation, 3.4. So now I can see is that if nominal growth is 3%, then real growth must be minus 0.5%. Can you see here? Because I'm now saying inflation is going to stay exactly the same. I'm not making any changes to inflation rate. So I'm only making a change on the GDP minus 0.5%. Because I've got inflation, the deflator at 3.4, and I've got growth here at 3%. So I'm saying this as well, now we're going to have real growth of 0.5%. And if I go down in my table, I can now see is that what will be my revenue outcome for a given tax to GDP ratio. I'm not changing the tax to GDP ratio. I'm just changing the GDP. I'm saying we're still going to collect 25.2%. Whether that's plausible or not, you can argue about it and say, okay, if we're going to have less revenue, the tax to GDP ratio will be less and stuff. But you have to make some assumptions to hold your framework stable so that you can just measure the direct impact on revenue. So if you know it's going to be minus 0.5%, this will then be your tax at the given inflation rate will be 10.781. And if I remember correctly, it's that number of 422 million. So now I can put in my report for our given tax to GDP ratio and for a given inflation rate. The impact on GDP will be 1633, and it will give us a total nominal growth of 3%. And that means real growth is going to be minus 0.5%, and we're going to lose revenue of 422 million. It's very simplistic, it's very high level, but I mean is there's actually no other way to calculate it in an hour if you are given an hour to give the calculations. But now you also know, is this really what the outcome could be? Because it's a long-term impact if all the factories need to close. So what you're doing is what is the impact of tariffs on export? It's an economy-wider impact. You remember the SAM is economy-wider impact. So it's not only impacting textiles industries, it's also impacting on industries feeding into the textile industry, labor, and materials and everything. So what will be the economy-wider impact? Once again, this model doesn't have the answers, but I said assume that the economy-wide impact will be 1.5. So I'm saying is, if that is the direct impact, economy-wide impact will be 1.5. Now, if you want to argue with me with about 1.5, we have to go back to the SAM. The SAM has got the multiplier. The SAM will tell us what is the economy-wide impact. This 1.5, I've just put it there in as a plausible number that it could be 1.5, but I'm not quite sure whether it's 1.5. But what I can tell you is that in this economy, the textile industry is quite important as an employer and as an export, if I look at the impact of exports. Then you once again is going to calculate what the GDP will do. And so you will then just multiply your direct impact with 1.5. Now you've got economy-wider impact. You will see what it does to GDP. You must remember that is a total impact in year one. That might also not be the case. But in this instance, you want to see, but how big is that impact of the shock to the economy? And then you will see nominal growth is now only 1%. So if you go to here, now you take the new calculated GDP as a percentage of the previous year, and nominal growth is 1%. Then if you do your calculations, then you will see is that GDP growth has to be negative minus 2.5%, and the new revenue will be 10.6 billion, and that's 639 million less than what we anticipated. And you can also do a percentage change, because sometimes you don't want to, you can just say, well, this is what the impact is going to be in percentage terms, and this is what the impact going to be in nominal terms. So this is the total impact in year one, calculated on year one. So yeah, sometimes you get people that will say, yes, as well, we would rather want to see how much is this year's impact, how much is next year's impact, but for that you'll need a different technique and you will need a different model to calculate it. But this gives you a quantum of what are the numbers that you're looking for. And if you don't have something like this and you don't have a SAM, then you will also be sitting in the meeting and you won't be able to actually contribute to a meaningful discussion. So this is typically the case. Do you want to let the train go by, or do you want to participate in the meeting and give inputs and say, listen, if I look at the assumptions of our budget, I look on what we think we're going to collect at a given tax to GDP ratio and a given inflation rate, this is the impact on growth, and this is going to be the impact on revenue. This is the direct impact, and this is the economy-wide impact. I think you should make the difference on how serious is the scenario that you actually are sharing with colleagues or with management. Okay, so I think this is the tax to GDP scenarios. And then I've just done it in graphs. I think I've just marked it. So, because sometimes graphs tells a very good story if you're going to talk to management, and it will just show you the scenarios with what we've now calculated here. So it's, I think it's in a picture here, sorry. So you would be able then to see but what is what was our target, and what are the simulated tax revenue if we keep the tax to GDP ratio constant and the inflation rate constant, what happens to GDP growth rates? And we can also then see what's going to happen to, this is inflation, that's growth rates. We have to look where's the tax to GDP ratio. Okay, are there any questions? Okay, if there are no questions, we can move on to the last one we're covering this morning. That is the sources of change. We've only got a few minutes left, but I think it's enough because it's much shorter to cover. Like I said, I think some of our colleagues here in the room will remember the sources of change model that we shared on previous occasions. I haven't done it this time, just basically because it's such a very big model and it's sometimes just blur on what you're doing if you can't get all the data together. So I thought of just focusing on the sources of change and how you calculate it. So this is the macro data. So this is just data that you have to put together for your different tax types and your total revenue, because you are going to use your buoyancy ratios, and the buoyancy ratio is the percentage change in revenue divided by the percentage change in your macroeconomic indicator, and that gives you that coefficient so that you can apply it in the sources of change. And then this is just your revenue. If you remember, you saw your revenue analysis sheet. So this is just where all your revenue is. And you will see the buoyancy ratios has also been calculated here. So you just take the change in your revenue divided by the change in your base, and it will give you the buoyancy ratio. And then you will also see you've got an average buoyancy ratio if you go to the right. So this is a sheet that you've been working on Monday. So if you want to do the sources of change, and I've shown you the formula when we were going through the slides. So all you will do is you will put down your total tax revenue. In this case, I've put the buoyancy ratios, I've put the real economic growth, and I've also put the GDP inflation. So why would I split growth and inflation? Because if you are going to analyze your tax system in terms of sources of change, you can do nominal, and you can say, well, this is the change due to economy. But it's also good to see what are the changes in your revenue that's coming from real growth and what is coming from inflation. So it's just to add another depth to your analysis. And then you will see is that, so the sources of change of growth, GDP real growth, and GDP inflation, the sources of change. So if I put in the formula here, you will say is what is my buoyancy ratio times my real growth. And then you'll have it for each year, and then you also will have your calculation here. So what is the share? What is the share of real growth to the total change in your tax revenue? And then on the GDP inflation likewise, what is that share in terms of the total change in tax revenue? And then you can, this is working now out the percentage. So you will see of the share of your revenue coming from real growth is 4% and 9. And that explained then 88%. And then I've just put in the average share here. So you can have a share for 24-25 total tax revenue, or you could have an average share. So just explain how much of your revenue are coming from real growth and how much is coming from your GDP inflation. And then you can do it then also by tax type. So this is the annual change in your revenue. That's explained by the economy. Now, can you see it's not 100%? So the rest of it is actually coming from administration and policy changes. So all this is just doing is using the buoyancy ratio, the GDP inflation with the buoyancy ratio to explain what will be the changes in tax revenue. So that is the annual change in total tax revenue. And then you're going to say and then you're going to use the buoyancy ratio with the change in GDP inflation. And you're going to do similar, doing similar for real growth. And then you know that if you don't want to work with an annual, for the latest year of buoyancy ratio, you can also work with the average share. So over this period, the average share that came from the economy, the nominal economy, if I just highlight this for you, will then show that 59% has come from the economy. The rest you can't explain, it's not in this sheet. Now, the sources of change model provides for those administrative and policy changes, but you need all the data, you need compliance data, outstanding debt reductions, increases in debt, late payments, no payments. So in that triangular that I shared with our colleagues that you saw on the line, you've got policy gaps and you've got compliance gaps. And to be able to answer this difference that you can't explain here, that's not coming from the economy, you need those tax gaps, policy gaps, and compliance gaps to actually explain the rest of your total tax revenue. Now, I think if you add the tax gap, the policy gaps and the compliance gaps, I think it might exceed 100% or it might be less than 100%. Then that factor we call the error term. So it is in the biggest sources of change model. We can share it with you, I don't mind. But you need that detailed information on your compliance and your tax policy changes. At the moment, many of us, even in South Africa, we're limited to what is the economy giving us. And we are more and more in our reports. You can see in our strategic and revenue performance reports, we are more and more reporting on compliance revenue. So that will fill a big gap, but we've also got the tax expenditure statement. So I think if you combine that we have in South Africa, you should be able to complete this calculation with the information that you get from the budget on tax expenditure and on the compliance reports. In your countries, I'm not quite sure how you report on compliance and on tax expenditures. If you don't have detailed information on that, it's perhaps something that you can work towards so that you can explain the change in your revenue coming from compliance efforts and coming from tax policy changes and coming from the economy. You remember when we did it on Monday, the presentation, we mentioned the 3 streams, and if you use these techniques and these frameworks that I've given you, hopefully you would be able to put a full picture together so that you're also able to report on your compliance gaps and your policy gaps. If you don't have it, you'll have a more macro view of saying administration and policy gaps together explain 40% of my revenue changes for the period 2018 to 2025. If I just look at the previous year, 88% of the change in my revenue came from the economy. 22% came from tax administration effort. And then you can also see how it differs from year to year. I think we've got the gentleman yesterday that explained to us, you can look at a point, or you can look at the trend, or you could look at, a longer term to get more insight in what's happening in your tax system and where's your revenue coming from. Okay, are there any questions? It's, am I right if I'm telling you it's lunchtime? Just we eat a lot here. Somebody told me, somebody that's not fat told me on Monday, whenever he comes to conferences he gets fat. I said, you can't get fat. He said, I do. So I'm glad some thin men also get fat. Okay, please enjoy your lunch. We will be back at 2 o'clock. And then it's time again for practical exercises. And then please ask me questions. And if I forgot to tell you something or to share something with you, my only goal being here is to share as much as I can, because I want you to go make the difference. And you must add more techniques and analysis and improve on what we've got currently. If you've got more data and more ways to look at it. So, yes, please. Tomorrow we will do the 2 forecasting models, and now you know how to look at the forecast of your tax revenue, given now that you know everything that's happened in the economy and also what's happening in your tax revenue analysis and performance. And now you know how difficult it is to forecast. I think tax revenue is the most difficult figure to actually forecast. Okay, thank you.
So I was looking at the sources of change.
Yeah.
Where we have real economic growth and the real economic growth and the real consumption growth. So where do we get this data from?
Okay, so real consumption growth, you should get it out of your national accounts data. So you're either going to get it from your statistical agency or anyone that's got a macroeconometric model. Usually a macroeconometric model is forecast in real times and they add the inflation. So the macro data is not generated by revenue authorities unless you've got a unit that develops macroeconometric models. So the inflation rate usually comes from your statistical agency, and in South Africa now they also do the growth rates. The GDP growth rates and inflation rates, and it usually comes from survey data. Yeah. So it's also a soft number. Yeah. So, but I mean that's unfortunately as long as you're being consistent. What statistical agencies try and do is be consistent on how they deal with data. So over time you can compare if there's consistencies in your data.